Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our monthly research briefing. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us. We hope that you find the following information in today's briefing useful. Also, know that CAPIS records and saves these research briefings on our YouTube channel for future viewing. So in case you missed something and would like to review a portion or all of this broadcast, please visit the CAPIS YouTube channel and select Research, either the Home or CAPIS Research Briefings tabs. You can also read a brief recap of the briefings topics on our website, www.capis.com. Click on the News tab and select Insights. And here we go. But before we get started, I got to read the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, Inc., CAPIS, or any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And I'd like to get ready to turn it over to Katie Stockton. But before I do, please note that Katie will take questions at the conclusion of her remarks. We ask that you type them into the Q&A portion of your Zoom, and we will be sure to get to them. And now, on with the call. Katie Stockton, CMT, is founder and managing partner of Fairlead Strategies, LLC. Prior to forming Fairlead Strategies, Katie spent more than 20 years on Wall Street, providing technical research and advice to institutional investors. Most recently, she served as Chief Technical Strategist for BTIG for 4 years, and prior to that was Chief Market Technician at NKM Partners for 9 years. She also worked for the technical strategy teams at Morgan Stanley and Witt Soundview. Katie, as always, glad to have you. Welcome.
Thanks, John. It's good to be back with you guys today. Shall we get started?
Okay. Absolutely.
I'm going to share my screen here, and hopefully y'all can see this okay. Bear with me. And there we are. So hopefully that works okay in terms of the screen share. We have a lot to talk about, and that happens with the volatility that's really picked up this year to date. I call it the sort of inverse property of technical analysis, which is, of course, our discipline. It's when the markets go down, that's when the demand for technical analysis goes up. We really have found that charts are one of the best ways to navigate through this type of volatility on the downside, especially when things get, I guess, as top-down oriented as they have done over the past few months. It's when you start to see correlations increase, and therein the top-down views really become that much more important. The S&P 500 and other major indices, their price action really influences just about all of the underlying, so that it's not an environment that you're rewarded for, great stock picking necessarily. And it just is more difficult to navigate in general. So we have some tools that we'll show today to sort of show you how we're approaching this tape and what we're thinking in terms of directional biases across timeframes, and also where we think a buying opportunity and when we think a buying opportunity may unfold. And the short answer is that we don't think we have one right now, unless your time frame's about 2 weeks. So let's get started on the charts here. The S&P 500, you can see on this slide. I'm going to get my pointer going. You can see a long-term uptrend. You can see it in the cloud there as well. So this is a shaded trend following gauge that we use as an indicator of the prevailing trend, but also potential support or at times resistance. So here's our secular bull trend. But within that context, we've seen a very notable loss of long-term momentum. You can really see that here in this middle window. This is called the MACD indicator. It's a moving average based tool that has crossed over into a sell signal. And these sell signals, the durations really vary, and we don't have a great sample size over history of them, but we always assume about 9 months in terms of the indications of that sell signal. There's a big lag to the indicator because it is based on historical moving averages, but it will help us identify big shifts in trends. So we feel that we're in the midst of a cyclical bear within a secular bull. And before we saw the peak in the S&P 500 at the start of this year, we had some signs of upside exhaustion based on the DMARK indicators. And the DMARK indicators are counter trend tools that basically run counts of the price bars looking for various qualifiers. Things like, well, what is the high higher than the high from 2 bars ago? Yes. Okay, a sign of 1. It's when you see this model yield these 13s that you tend to get either consolidation or reversals like we've seen. So the implications of that signal still puts us out into the framework of having a few more months left to this corrective phase, if you want to call it that, or to this bear market cycle. Notice here also that the S&P 500 is not yet long-term oversold based on that stochastic oscillator. So if you just kind of zoom in here and look at the weekly bar chart of the S&P 500, for the technicians on the call, you can see a bit of a head and shoulders top here and the subsequent breakdown below this weekly cloud. Also an older Fibonacci retracement level of roughly 4,200. That to us affirmed the bearish reversal that became evident at the start of the year. And it put next support here, which is about 3,815. With secondary support now around 3,500. You can see the negative momentum here, intermediate term, and this is why we're not recommending adding exposure into this downdraft, even though we do have some signs of short-term downside exhaustion. Those downside exhaustion signals that we have are on the daily charts, and their duration or indications for duration are only in that kind of 2-week time frame. So we're respecting the downtrend as it stands. Notice here we have 2 ratios. We have a ratio of growth to value on the large cap and the small cap front. And you can see that with the downtrends that we've had, you've really seen downside leadership come from growth versus value. And that marks a shift, of course, from what we saw in 2020, where we had upside leadership from growth. And it became evident in early 2021 that the small cap growth complex, this is your sort of high growth technology, ARK-K type of names, really had reached valuations that were unsustainable. And of course, we're in this pretty well-defined downtrend. We believe that there's probably more downside for large cap growth than there is for small cap growth, just given the duration of these trends in part and the sort of the relatively new breakdown for growth versus value on that large cap front. So we think that this sort of downdraft that we're seeing, that while we still do have downside leadership from small cap growth at this time, that now it will be more on the large cap front that we actually get that downside follow through. And of course, that brings us to Apple, Apple being the biggest heavyweight in the major indices. And you can see Apple has also entered a corrective phase. Prior to the last, I'd say 3 or 4 weeks, Apple was an outperformer. You see in this ratio here versus the S&P 500. It was only very recently that we saw a breakdown in that ratio. And that, of course, is a negative development for the major indices in that they have this heavy exposure to Apple. And now Apple is right into some long-term support based on this cloud model, based on this previous highs here. Natural place for an oversold bounce. But we would suspect that after that bounce or any stabilization that we'll see a more decisive breakdown, just given the same from a lot of Apple's peers and from the major indices themselves. In terms of looking for a bottom, there's a lot of things we look for. So I wish there was one answer as to, hey, Katie, what do you see at a market bottom? We see a lot of things. One sort of category that we consulted are the market internal measures. So breadth, sentiment, leadership, and volume. In our morning note, we tend to publish this table. And in this table, we have overbought and oversold readings highlighted in green and in red. And you see we have a lot of green, meaning we have an oversold reading that's somewhat widespread among these market internals. In fact, last week was the most oversold we'd seen since the COVID corrective low in early 2020. And yet before that COVID corrective low, we had a lot of green for about a month, maybe 4 weeks or so. So these oversold extremes can stay that way for some time. And that's why we always consult momentum gauges to enhance what we're seeing here. So, but we, like I said, we do have this oversold reading in terms of breadth, the percentage of stocks above their 50-day for one. Sentiment, we have that fear and greed index I'll show you, quite oversold. And even yesterday with a big 4% downdraft in the S&P 500, we had a 15-to-1 down volume to up volume ratio, which is not really sustainable on the downside, as you can imagine. But with that oversold reading, you can see the nature of the cumulative measure of market breadth here, this advanced decline line, where it's broken a longer term uptrend after deteriorating for several months. And that's why even before year-to-date weakness, we had a pretty tough market. It was a difficult market to take advantage of on the upside late last year. And that was really a function of that participation as measured here. Now the percentage of stocks above their 50-day is quite oversold, but we're not quite there yet in terms of a long-term low, which would be represented by this measure, which is the percentage of stocks above their 200-day moving average, is a bit of a longer term, sort of less sensitive trending gauge of breadth. So we'll be looking for this measure to dip below and maybe even significantly below this 25% threshold before a long-term low is established by the major indices. So this is not lost on anyone that we've entered into this higher volatility cycle lately, and year to date, it became, of course, very prevalent. You can really see it though in the VIX. This is something that we started looking for late last year with that sell signal that we highlighted. Notice this curvature of the 40-week moving average. It just shows the cycle that we've gone into where we're seeing higher lows in the VIX on this momentum shift higher. It cleared the cloud-based resistance to that shaded area. And we have, of course, now resistance just in the mid to high 30 range. So we think eventually we're going to see a volatility spike above that level, above that resistance level. But for now, as we grind lower in the major indices, we expect just to see the VIX make higher lows. And eventually it will become, or at times it will be, a good market hedge, just given its inverse correlation to the S&P 500. Although people, and we, us included, tend to struggle with market timing those spikes in the VIX, but it is one way, one avenue to hedge. And we look at it as just a gauge of market sentiment that's transactional in nature. And eventually we'll get out of this higher volatility cycle. The high volatility cycles tend to last shorter than the low volatility ones. But they are, somewhat unsettling. So we had, of course, this one, which was a bit of a sharp event there. But back in here, we had a higher volatility regime. It only lasted a few months. So we'll see how long this one lasts, but we're definitely in the midst of it. And then in terms of market sentiment, also transactional in nature, this fear and greed index is really very interesting and helpful. And you can see that when it's down below this green line, which is 25%, and it's based on a collection of things, including the VIX actually, that gauge market sentiment. When it gets very low, that's when you tend to have the stuff of market lows. But it usually takes time. So if you think about here, it got below at the COVID low, which probably isn't the best comparison in the current environment. You can see it gets down, stays down there for a month or so, finally bottoms, and then on its way up. And really the clear buy signal is when it gets back above 25% more decisively. 2018-19, you can see it really flirted with that oversold territory for some time. So it creates a backdrop that's conducive to low. But it takes time for it to really have an impact, especially in a downtrending tape. So we'll wait for it to really improve and also improve at the same time. Momentum is improving. So things like that weekly MACD that you saw on the weekly chart, once that starts to really turn in earnest, at least we'll feel like we have some kind of intermediate term bottoming process underway. These are ratios here that you're seeing of developed global and emerging markets versus the US. You see long-term downtrends here, even just in the curvature, the purple line, which is effectively the 200-day moving average. Within that context, we definitely have some stabilization, so some relative strength improvement behind international markets. It's hard to say that it's significant at this time, but we do think it will actually continue either sort of inline performance to outperformance from international markets here as the US market continues to fall out of favor, but that it should be temporary within the context of these longer term trends. So as soon as we feel we have a good bottom in the S&P 500, my sense is that it will sort of reassert itself as a leader globally. But in the meantime, we have some potential rotation. Of course, relative strength doesn't necessarily mean absolute returns. So we definitely keep that in mind. We don't all live in sort of relative worlds. I know, some of you are probably managing money that's more market neutral. So certainly you do live in a relative world, but we all want to also make money. Here's the dollar index. This is a long-term view, monthly chart going back to year 2000. You can see this big range, and then within the range, some very steep trends in either direction. This uptrend is now showing signs of exhaustion from a long-term perspective based on the DMARK indicators in part, and also based on the stochastics, which you don't see here. But you can see it's into resistance with a sell signal. That suggests we'll see the dollar enter a counter trend move for up to about 4 months are the indications from the signals that we have. So with the exhaustive signals in the dollar also shared by Treasury yields, we're looking for a bit of a relief of this kind of trend on the macro front. And usually what you see when the dollar tends to start to downtrend or correct, you do see relative strength out of emerging markets, which is replicated here, improve to some degree. So if we get into sideways to lower here, again, we'd look for improvement in relative strength behind emerging markets. And we suspect that that's somewhat related to China and how deeply oversold some of these Chinese names are long term. It's not to say we're recommending buying them, but we do think that they may have a bit of a floor underneath of them based on some longer term support levels and some signs of downside exhaustion in relative terms there. Here's a chart of Bitcoin. We believe that Bitcoin is really best analyzed using charts. And here you have a candlestick chart. It's a weekly, and it shows price history back to 2019, thereabouts. And recently we saw a breakdown below our trusty cloud-based support level. That was roughly 40,000. That essentially becomes resistance now going forward. We suspected that we would see a breakdown just given a loss of long-term upside momentum that Bitcoin shared with the equity indices. So we had both the NASDAQ 100, the S&P 500, all see these monthly MACD sell signals, which was shared ultimately by Bitcoin too. So it seems to be treated now as a risk asset, whether that's right or wrong. We can't really comment on that, but it certainly seems to act that way of late, with correlations really having picked up year to date between Bitcoin and the major indices in the US. So we're trusting that this downtrend will keep its hold for now, noting that it has negative momentum intermediate term. And while it's oversold, there is room to support. We're calling it about 27,200. So perhaps a relief rally at some point here soon. And yet it's not something that we'd be willing to trade as of yet, with the negative longer term momentum still very much an issue there. So it doesn't mean that the bottom's dropped out, but there's still room to the downside, especially if that 27,000 area is taken out. For gold prices, we have seen a pullback develop there as well. And it's a pullback still within the context of a gradual long-term uptrend. You can see it for the most part in sort of just the higher lows over time, and also in the trajectory of the cloud model going forward. But we really need to see gold hold in this area, but we're calling it about $1,800 per ounce. close to in line. We just want to see it hold and not post 2 weekly closes below that level, which would be a breakdown in our work. We think it will do that just based on the fact that it did break out from a triangle formation ahead of this corrective phase. So that those triangles tend to be pretty high probability. And this is a longer term setup that we think will give way to a resumption higher. But there is weak momentum. And let's see if the oversold conditions can give us the bounce that we're expecting to preserve that support. In terms of crude oil prices, in the search for areas of the markets that are working, that have, positive momentum, at least long term, it's hard to find that right now. And crude oil is one of the sources of it. So crude oil, also the energy sector, for the most part, has maintained positive long-term momentum and even positive intermediate-term momentum, depending on what names you're looking at. But within the context of this uptrend for crude oil, it's been in a consolidation phase that we've been actually calling a bit of a short-term triangle formation. We now are essentially seeing a retest of this long-term zone of resistance between about $110 and $115 per barrel. The indicators are somewhat mixed at this time. So while long-term momentum is positive, we have seen a downtick in intermediate-term momentum that gives us a little bit of pause, but we still want to stay with the energy complex until we have something a bit more decisive in terms of either a breakdown or some kind of downtick that's more meaningful than what we've seen. We show support on a short-term basis at around roughly 100, so that's a bit of a breaking point in our work. But for now, it being, one of the areas that's exhibiting positive relative strength and momentum, we're still quite happy having some exposure here, noting also that if it were to clear decisively the 115 level, meaning like a couple good strong weeks above, we could see, or we would have next and final resistance around 147 per barrel, which is based on the 2008 high. 10-year Treasury yields have been on a tear, and as mentioned, aligned with our commentary around the dollar index, we are expecting some counter trend activity here in Treasury yields. I don't think it's really something that would surprise anyone, but importantly, to frame this move longer term, there was a multi-decade downtrend channel going way back. This just shows back to 2000, but it goes back farther than that. And with the latest up move, it did clear the upper boundary of that channel, which felt like very far away at one point. Now, of course, it's manifested itself as a breakout already and puts next resistance at this high. That's roughly 3.25 based on the 2018 high. You see the upside momentum here. So ultimately, we think that 3.25 is cleared. That would then put next resistance around 4. But in the meantime, we are looking for even a few months of consolidation, sort of sideways to lower here, based on some indications that we have from this weekly bar chart from the DMARK indicators in part, which have some signs of exhaustion here near the resistance level as these overbought conditions are absorbed. So we're looking for sideways to lower here. But within the context of what was a pretty major long-term reversal that tells us that we should continue to see upside from Treasury yields, albeit perhaps not of the trajectory that we've seen of late. And in following with the call for stabilization or for consolidation, we're looking for stabilization in Treasury bond prices. Interestingly, this is a chart of TLT on a weekly basis. You saw a DMARK sell signal here in this 13. Now we have a DMARK buy signal, and it's not for the faint of heart to buy something that's in a downtrend like this. But again, in the search for something that's working in this tape, well, this is an area that we think will work, and certainly at least will work in relative terms versus the S&P 500 for right now. So with the S&P being out of favor, this is where treasuries tend to do a little bit better. That certainly wasn't the case in Q1, which is a little bit of an anomaly. And yet now we finally have these sort of exhaustive signals near what was a targeted level of 116 for TLT. And we spend a lot of time, for those of you especially that know our research, we take a lot of time focusing on sector relative strength trends because we believe it's really one of the best ways to outperform the S&P 500, just to be in the right sectors. And you can see why, is there's always a really wide sector dispersion in terms of relative performance. This year has been a little bit wacky, of course, in terms of energy being up more than 44% as of this writing, versus discretionary down 30%. You can see a bit of a sliding scale here in terms of relative performance and just how incredibly important it is to be in the right sectors, which if you look at the S&P 500 return 18.5%, you generally needed to be up here in order to outperform. And then for 2021, we have the same comparison. Energy, again, the big winner, but go down the spectrum and you'll see that staples and utilities were the big laggards here. And it just begs the importance of being in the right sectors. And also when you think about that, especially as it pertains to the S&P 500, the footprints of these various sectors can vary a lot. So tech being 27%. If you lose that sort of relative performance from technology, which of course has been the case this year, right down here, that's, of course, when it really takes its toll on the S&P 500, which has such a huge footprint in tech. Healthcare, discretionary financials, other big sort of heavyweight sectors. And then you get into sort of smaller sectors. And we actually launched an ETF recently. The ticker is TAC or TACK. And it's essentially the goal of this ETF is to leverage just what you see here, this sort of sector performance, the sector momentum and relative strength. And what's interesting about TAC is that when it has sector exposure, it also has an asset allocation piece that moves it into treasuries and gold at different times. But with the sectors, we're equal weighting these sectors. And in doing so, we're navigating through what you see here. Whereas if energy is working, which of course it is right now, even though it's only got a 4% footprint in the S&P 500, we're giving it about 12.5%. So we're giving more weight to the sectors, the smaller sectors that are outperforming. So it's only when technology is outperforming all the time that can be, that equal weighting strategy can be detrimental to performance. This is called an RRG. It's a relative rotation graph, and you can see it shows the S&P 500 sectors. Usually there's a real cyclicality to that. There's a little bit less of one right now. You'd normally see everything kind of going in this clean clockwise rotation. But because we've had such a correlated market and these top-down influences have been so strong, it's been a little bit closer to the middle outside of energy, as you've seen. But you can see over here, utilities, staples, healthcare, real estate are all to the right of the crosshairs, which represent the S&P 500. And that means that those more defensive sectors have done better. They've had relative performance. Whereas you can see these other sectors over here, these have been the laggards. So financials and tech and discretionary communication services. Normally you would expect that clockwise trajectory to maintain itself. This year it feels a little bit different perhaps, but for now it just kind of reflects that outperformance by the defensives. And so in our weekly report, we publish these charts, excuse me, and you can see that this S&P 500 sectors and then their relative strength versus the S&P. So this is kind of the visual representation, sector by sector of what you just saw on the RRG chart. And you can see just massive trends either way. This is discretionary, downtrend, staples, uptrend, energy uptrend. So this is outperformance when you see this line moving higher, healthcare outperforming. So the sectors that are bordered in green are the ones that we are currently holding overweight recommendations on. Notably, that does not include technology. And of course, this is a bit more of a large cap picture, right? So these are the S&P 500 sectors. So the tech sector and consumer discretionary sector are really largely attuned to the mega caps, Amazon, Apple especially. So when those aren't working, these sectors tend to get penalized, just kind of in general and broadly. So that's where I'll wrap up these slides, and I'm quite sure I've stirred up some questions, and I'll just leave my contact information up while we take the questions.
All righty, Katie, thank you so much for your presentation. We have opened it up to questions, so we just want to, excuse me, give everyone a chance to ask. A lot of information in there, Katie, that goes way beyond what we talked about in our pre-Zoom moments there when it came to some things. And as we're waiting for some questions, I just want to remind everyone again about the CAPIS YouTube channel, where you'll be able to find this replay as well as others from some of our other speakers throughout the last year and a half. So we're just taking a look at that. And I'm going to check our question queue right now. There's nothing there yet. So we'll give everybody a second. Katie, I know last time we talked about you were following cannabis a little bit more. Is there anything going on in cannabis? Seems like every other market or sector is having something happen, whether it be oil or the mega caps and technicals. Is there anything in cannabis that our viewers should be on the lookout for, shall we say?
Yeah, I mean, I would say yes, for sure. It feels a little bit like a binary space right now, unfortunately. Like folks are waiting for some good news, perhaps on the federal front for cannabis regulation. And because of that, because of that, also combined with a weaker market, these downtrends that unfolded early last year, at the same time we saw kind of high growth fall out of favor, have kept hold because we just haven't gotten that good news on the regulatory front. And because of that, we've seen downside momentum long term. We've seen weak relative strength, meaning performance versus the S&P 500. This is a weekly bar chart of MJ, just one of the ETFs that we publish in our monthly report. And like so many other things in this kind of higher growth arena, you see there's a DMARK signal that suggests that perhaps it could try to enter a basing phase here and a subtle uptick in momentum, meaning like a loss of downside momentum within its downtrend. But it would be a bit premature, I think, to suggest that there's a low in place here. I think with this kind of downtrend, we'd expect to see a basing phase develop before we actually get a proper breakout. And that breakout would of course, be our catalyst to add exposure.
Okay, thank you, Katie. We have a question from the field here. This question is from an anonymous attendee. I believe you said you expected the cyclical bear market to last around 9 months. Do you feel we are 4 months in and we could start seeing upside in the fall?
Yes. So short answer is yes. And that's based in part on the combination of sell signals that we have. Now, my indicators aren't really predictive in that way. I can't say with confidence that we bottom in September, but just looking at historical averages, that's usually about the duration of these sell signals that we have. And to your point on the number 4 being 4 months in, you actually see a 4 right here on the chart. This is the monthly SPX. And at least per the DMARK indicators, we're essentially 4 months into the counter trend move, if you want to call it that, this cyclical bear. So I think if you think about that in terms of 5 months from now, puts us out perhaps into October to resume higher, be a stronger Q4. But instead of saying, okay, we're just going to be on the sidelines and wait for that entry, we're going to look for a collection of items to suggest that the market's ready to resume higher. It's a combination of momentum gauges, primarily support levels, counter trend signals, and market internal measures. So all of that taken together is what's going to help us try to identify that big long-term low, kind of irrespective of the timing of it. If we see those signs before September or October, we'll obviously welcome them because we much prefer to have a bull market. So we'll always be on the lookout for those triggers.
I like that, Katie. We much prefer a bull market. I have another question here. Someone asking about gold. You mentioned gold may break down if the 1800 level does not hold for 2 weeks. If gold did break, what would be the next resistance level?
Yeah, or next support level, I assume.
Yeah, I think that's what they mean there.
Yeah, so it's a good question. This is the monthly chart of the generic contract of gold. you can see basically why it pivoted here, because there was long-term resistance 2063, and that was tested here unsuccessfully. And here's a subsequent loss of long-term momentum. You don't see the 1800 level, which is derived from a weekly model on this chart, but you can see a Fibonacci retracement level of roughly 1675. And notice it also captures the low from March of 21. So 1675 to us, based on this longer term Fibonacci level and also the 2021 low, is the secondary support level for gold. And obviously that would be, pretty significant downside. So certainly we would be respectful of any kind of breakdown below that 1800. It's about 9% below current levels. But if you think about that in relative terms, versus say the NASDAQ 100 and the room that it has to next support, even if we do see gold break and we have a continued sort of bear market move from the major indices, we could even see gold outperform, meaning outperform equities. So as much as it's not really that promising right now, momentum wise, we are even seeing relative performance. This is gold versus the S&P 500. And if you look downtrend here, it reversed earlier this year. And you can see whether you look at the curvature of the 50-day in purple or the yellow 200-day moving average, you can see what appears to be a turnaround in relative strength for gold prices versus equities. So even if they don't look fantastic in terms of momentum, there is relative strength behind precious metals.
All righty, Katie. Looking there, I don't see any other questions in our queue. So as we exit out, first of all, again, Katie, thank you so much for joining us today and giving us your time. And pending no more questions, this is going to conclude the monthly CAPIS research briefing. We'd like to thank everyone for tuning in today and giving us some of your trading day. Our next briefing will be on June 16th. It's going to feature Nick Collis and Jessica Rabe of Data Trek. On behalf of the CAPIS family and Fairlead Strategies, we want to thank you for watching and have yourself a great trading day. Katie, bye-bye.
Bye. Take care.